Alrighty, so today we're specifically talking about R&D tax and overseas activities and the eligibility of those. There are a lot of questions that I commonly get in the last few months. I've seen a lot of cases, a lot of scenarios where people are kind of struggling with how to treat overseas activities. They might not have the right information, might be incorrectly claiming or not sure what they can claim. So we've kind of collected a lot of the FAQs and misconceptions and tried to build a webinar around that. So as per usual, we have to make a disclaimer. So nothing in this webinar should be taken as specific tax or legal advice. And you should always contact your accountant, R&D tax consultant, lawyer, etc., to discuss your particular circumstances. So Fullstack is a chartered accounting firm. We've been going since 2017, and we're really the one-stop shop for startups, entrepreneur tech companies, scale-ups as well now. A lot of our earlier clients are starting to go into that scale-up and growth phase. So yeah, the one-stop shop for all those accounting needs. And then this is me, the R&D tax manager here at Fullstack. So dealing mostly with R&D tax, but other government grants and incentives, which we might touch on further in the presentation. On the agenda today, starting with an overview of the R&D tax program. So I'm not going to go in as in-depth as I normally would for other presentations. We do have webinars, a lot of content on our website just around the basics of the R&D tax program, and obviously there's a lot on the ATO and the Oz Industry website. So if you have further questions around the underlying eligibility, there are a lot of sources, and please feel free to contact us as well. We'll discuss overseas findings, what they are, when and why you need one. We'll touch very briefly on some recent developments around overseas activities, address some common FAQs and myths, cover the benefits of conducting R&D in Australia, and provide some examples at the end. So first off, the R&D Tax Program Overview. The R&D Tax Program is the federal government's broad-based scheme to incentivize experimental R&D activities being conducted primarily in Australia. So it's available for all companies, all sectors, pretty much. It's a yearly claim process. The company is required to assess the activities that they've conducted and the expenditure that they've incurred on those activities, and prepare and lodge an application form within 10 months after the end of the financial year in which you've conducted those eligible R&D activities. So it is, for most companies, probably 97% of companies, it is self-assessment. So if you lodge an application form, it will be registered. If you submit R&D tax schedule as part of the company tax return, it will, in the vast majority of cases, result in either a refund or adjustment to the tax position. That doesn't necessarily mean that you are eligible from a technical or a financial perspective. It just means you followed the administrative process. So you can be audited or reviewed generally up until 4 years after you've made a claim. And that's when you might have to provide additional substantiation. And someone from the government might actually have a look at what you've done and assess whether you've claimed correctly. So you must have spent at least $20,000 in notional R&D deductions in a particular financial year. There is an exception if you use a research service provider. So that's someone like the CSIRO, a university, or a private research organization that's on that list, but generally $20,000 plus. For small to medium enterprises, so aggregated turnover of less than $20 million in the year, the benefit will be the company tax rate plus 18.5% R&D premium. So that gives you the 43.5% for most companies at the moment. Now, the benefit for companies under $20 million aggregated turnover is refundable. So if your losses are sufficiently large to cover the add back of R&D, you will get back that amount as a tax refund. So it's very useful for companies who are pre-revenue. You don't have to wait until you're paying tax to get that reduction in tax payable. So you can only claim activities being conducted for you, being the claiming entity. That generally looks at who has effective ownership of the results of the activities, so who owns or controls the IP, who controls the R&D activities, who bears the financial risk of conducting those activities. So if you're being paid by someone else to conduct activities on their behalf, they're the claimant rather than yourself. There is an exception to those on behalf rules where you are conducting activities for an associated foreign corporation or a permanent establishment. There are some additional rules around that. So the legislation refers to activities conducted wholly in Australia. That's the kind of top line of what can be claimed. And then as we move through the presentation, you'll see the other activities that can potentially be claimed. But for all intents and purposes, in most cases, you look at the activities conducted in Australia. Activities conducted outside Australia, either partially or wholly, can only be claimed if they're covered by an advance and overseas finding. So I mentioned core, I mentioned activities, so you need to assess the activities that you've conducted in a particular financial year. So we have core and supporting R&D activities. So this is really important just for the rest of the slide deck to provide a bit of context around how to structure those activities. It is generally good to break down kind of product development into individual activities to a certain extent that are sufficient to, meet the criteria rather than just, claiming 100% of all your product development. So the definition for a core R&D activity is an experimental activity that follows a systematic progression of work that is based on the principles of established science, that proceeds from a hypothesis through experiments, observations, evaluations, and leads to logical results and conclusions. The outcome of the activity must not be able to be known or determined in advance on the basis of current knowledge, information, or experience. And the purpose of conducting that activity must be to generate new knowledge. And so all those together constitute a core activity. There is also a list of excluded core R&D activities. The most relevant ones that I see pop up where computer software is being developed for internal administration purposes only. That's ineligible as a core R&D activity. Research into social sciences, arts, and humanities, again, is on that list. Market research and testing, management, studies and efficiency surveys are also some of the main areas to look out for there. There are also some others, but generally focus on the kind of tech and software realms and other kind of areas. So there are also supporting activities. So these are activities that are directly related to core R&D activities. Where they are related to the provision of a good or a service, they must be conducted for the dominant purpose of supporting the core R&D activities, i.e. the main purpose. Some examples of supporting activities might be your initial research, literature reviews to determine the state of the art and formulate your hypothesis. It might be cleaning up a site after the experiment, if it's some kind of physical experiment. Project management, resourcing, kind of administration of the employees and contractors potentially could be included. Also the development or the setup of more kind of standard functionality that is not itself an experiment, but is required to, for example, collect data for the purposes of conducting an experiment. That might be a supporting activity. So now that we've got that background out of the way, we come to where you may be able to claim overseas activities. So the default is not being able to claim overseas activities. So an overseas activity is one where the person generally, so if you think about activities, they're things that are done by people, where an activity is conducted by someone that is located overseas, it will be an overseas activity. And it is only able to be claimed if you have a finding, overseas finding. So you can apply to the ATO for an overseas finding to claim these activities. It also requires you to apply for an advanced finding. That's part of the same application process, but it's kind of two different findings. So an advanced finding must cover the overseas findings. So the advanced finding requires you to demonstrate to the ATO and Oz industry that your activities are eligible as either core or supporting activities. And then any related Australian activities also need to be verified whether they're core or supporting activities, or more specifically that they're core R&D activities. An overseas finding can last for up to 3 years, but there are mechanisms to roll those over without having to go through that full process again. There is always a risk that when applying to the ATO, they can make a negative finding. So keep that in mind. That could be on the overseas, but also your Australian activities. And you must make that application prior to the end of the financial year in which those activities are conducted. So where you have an overseas activity, you must demonstrate if you want to apply for a finding. So there are these 4 requirements. You must show that the activity is an eligible core supporting R&D activity. That's fairly straightforward why that would be the case. Number 2, you must be able to demonstrate that there is a significant scientific link to one or more Australian core R&D activities. So it's part of a broader project that also includes Australian activities. Number 3, you need to demonstrate that the overseas activity could not have been conducted in Australia solely because conducting it would require access to a facility, expertise, or equipment not available in Australia. That's generally the main reason out of these 4 under requirement 3. There's also conducting in Australia would contravene the Biosecurity Act or other laws relating to quarantine. It could require access to a population of living things not available in Australia. So if you were doing some research into a particular health condition and not enough people in Australia was living with that, so you had to go and do a clinical trial overseas. Also, the 4th one there is requiring access to a geographical or geological feature not available in Australia. So you might be developing processing technology for a mineral that isn't abundant in Australia, so you need to do it overseas, something like that. So that first one is the most relevant. Facility, so a piece of equipment, facility or equipment, or expertise, so where a person, or where you can demonstrate that no one in Australia has that particular expertise. The final requirement there is that the overseas activities, including those partially conducted overseas, have expenditure less than all of the related Australian activities over the course of the project. So that's really important. So the cost of the overseas activities must be less than the Australian activities. Now, some examples of overseas expenditure / activities. So this is where it can get a little bit confusing, where we have overseas expenditure incurred to companies that might be located overseas and activities that are conducted overseas. So where someone is physically located overseas. So obviously where people, employees, contractors are located overseas, that's ineligible without finding. Overseas design and development costs ineligible without finding. Overseas travel and attendance at conferences, that used to be able to be included in an administrative workaround by the ATO. They used to have a fact sheet saying that very small amounts of overseas travel, for example, attendance at trade conferences, could be included without a finding. That fact sheet has now been rescinded, so that treatment is no longer applicable. So no overseas activities or no expenditure associated with overseas activities should be claimed. Activity expenditure incurred on or incurred to potentially overseas entities that could be eligible without a finding would be materials and consumables purchased from overseas and used in Australia. So if I'm ordering parts, off the shelf from a factory in China, it's being shipped to Australia, I'm developing my experimental prototype in Australia and testing in Australia, that activity is an Australian activity and probably could be claimed without any issue. Or the cost of those materials, consumables, equipment also. The same goes with software subscription. So even though I might be purchasing a software subscription off a company headquartered overseas, if I'm sitting in Australia on my computer using that software subscription, I'd generally be able to claim that as long as I'm doing R&D. Also, obviously, activities covered by a finding will be eligible. Yeah, so findings can be determined prior to the expense being incurred. So the advanced finding means that it has to be submitted prior to the end of the financial year in which you would like to claim. So that could include activities and expenses that you've already incurred, or activities or expenses to be incurred or to be conducted or incurred. So some latest developments around this issue. There was a recent case put forward to the AATA, so the Administrative Appeals Tribunal of Australia, which is where R&D cases go before the higher courts, or used to go. I won't go into the full details of that. It was a real mess. The initial claim was a bit of a mess. And some of the things that they were arguing in front of that tribunal were also pretty messy and should have been avoided initially with claiming correctly or hiring a competent consultant, R&D tax consultant. But a really interesting and useful part of the ruling that got put down was the tribunal made a distinction between supply of components and the design and development, fabrication, and or supply of components of a prototype. So in this instance, the applicant, so they got quite a large refund initially, and then they went through this process and had to pay it back. They claimed a bunch of expenditure incurred on overseas activities. So where they engaged a firm in the design, development, testing, building a prototype overseas. And that was found to be an overseas activity, and therefore that expenditure was ineligible. Now, potentially if there wasn't any design development being done overseas and they just shipped parts to Australia, components to Australia, fabricated, developed the prototype in Australia, then that potentially would have been eligible as an R&D activity. So addressing some common myths and questions here now. So I've tried to collect the main ones that people ask. So the first one, if I'm paying an Australian company who are paying tax in Australia, can I claim expenditure that relates to overseas developments? So the short answer is no. The legislation refers to activities conducted in Australia or wholly in Australia. So without a finding, you cannot claim activities where the person conducting it. You can only claim activities where the person was physically located in Australia at the time the activity was conducted. So, saying, well, I'm paying an Australian company, so therefore I can claim, that's not correct. You need to verify where their personnel are located before you claim. If that wasn't the case, then that would be a very obvious loophole where you could just set up an Australian company, do everything overseas, but pay everything from the Australian company and claim it. Obviously, that's not the case. So the next step from that is a very common myth saying, well, I'm paying an Australian development agency, but I don't know that they are using overseas resources, or I don't have the capacity or the capability to find out. So I'm just going to claim everything, because if I don't know, then it's not an overseas activity, I guess, is the logic there. That's obviously an incorrect approach. It's incumbent on the claimant, the program is self-assessment. So if I want to claim expenditure relating to activities, I need to be able to determine whether they're eligible R&D activities. So if I am unable to determine whether they are eligible, potentially because they're conducted overseas, then as a taxpayer that has a level of responsibility to claim correctly, I cannot do that without figuring out where exactly they're located. Now, some people say, well, I can't, if I'm hiring a contractor or a third party to do my development for me, I can't dictate where their employees are located. And my response to that is, well, you can. If you're paying someone to do something for you, you can specify in the contract. If I'm a founder and I want to claim my R&D activities, then I'm going to make sure that those activities are eligible, that they're being done in Australia. If I'm contracting those out, then I'm going to specify in the contract that if I'm paying you, you can only use people located in Australia. So the next question, my developers are overseas, but I'm located in Australia. Can I claim my time? Well, it depends what activity you're conducting. So if you're a non-technical founder and you're not involved in the kind of coding, I'm using a software example here, it is the most frequently where this occurs. You need to really have a look at exactly what you're doing and determine whether, ignoring the overseas activity, whether you're conducting a core R&D activity. If you're only conducting a supporting R&D activity and all the core is overseas, then you can't claim your time, because an eligible supporting activity must be directly related to an eligible core activity. if the core activity, what would be the core activity, is overseas, then there is no core activity. It's ineligible, so there is no supporting activity. So it really requires you to carefully look at the activities that you're doing and register them accordingly. Another myth, well, I claimed overseas activities last year and my claim was approved. Sometimes I talk to prospective clients that have unintentionally claimed ineligible activities. They, I claimed them last year, my R&D was approved, so therefore I can claim them again. And the response is that, well, the R&D tax incentive is self-assessment. The receipt of a registration letter and even a refund is not approval in the sense that your activities have been verified, that your expenditure has been verified. At that point, it's self-assessment generally. So even though something slipped through the cracks in year 1 or year 2 or even year 3, that doesn't necessarily mean that it is eligible or it won't be reviewed, or potentially you might have to pay back money further down the track if they find out that you've incorrectly claimed. And then the final question here is, I can't afford to hire developers in Australia, so I had to hire them overseas. Can I obtain an overseas advanced finding to claim the development costs? So that's a really common one, and it depends on the particular circumstances. So if you read the legislation, it says that you can apply for an overseas finding where an overseas activity cannot be conducted in Australia because conducting it requires access to expertise not available in Australia. So if there was expertise that I could hire if I had more money, but I don't have more money, so I went overseas, then you wouldn't meet that requirement, and therefore it would be unlikely that your overseas finding application would be successful. So cost factors generally are not a reason to go overseas if you want to still be able to claim that activity or claim your R&D activities. So that's all FAQs and myths and conceptions. So just wanted to run through a few benefits of conducting R&D in Australia, potentially bringing overseas R&D activity back to Australia if possible. Obviously, access to the R&D tax incentive and other kind of related things. There is R&D finance, which is finance providers allow you to borrow based on future refunds under the R&D tax program. So obviously you need to have conducted eligible R&D activities and spent eligible expenses to be able to get those. So that might be an additional source of funding that you might not have considered. There are also government grants that are more favorable. If you're applying for a big grant, then having IP that has been developed by people in Australia will be more compelling to the assessors of those grants, the people handing out that money, than having IP that was developed overseas. There are also other programs like the Early Stage Innovation Company concessions, or the ESIC concessions, available to investors in early stage innovation companies, where that are easier to meet. The requirements are easier to meet if you have conducted R&D in Australia, just because of some of the mechanisms there. Being closer to the employees or contractors, in some instances mean that it's easier to oversee those resources. So that's potentially another reason to bring R&D back into Australia. And depending on the area that you're working in and all the costs involved, potentially there'll be more competent people in Australia. I guess will vary on a case-by-case basis, but anecdotally, if you can afford it, potentially having people in Australia will be better than certain overseas jurisdictions. So just quickly wrapping up here. So I'll try and race through these examples. They're just the 3 examples. So these 3 examples are very black and white. So please take that into account. There potentially are a lot of other examples that are between these, and it really requires you to look at exactly what's being done, potentially get the help of an R&D tax consultant such as myself to really assist you and determine what could be eligible and what not to include, or what could potentially be eligible under a finding. So this first example, very clear, or very kind of clean, the design, development, testing of a physical prototype conducted in Australia. 2 co-founders, one in Australia who does development and also provides project management supporting activities. The New Zealand co-founder only provides what would be supporting activities. In this example, they have sourced components for that physical prototype from overseas and also in Australia. So the R&D claim here would be most likely core activity, one, potentially multiple, for that development that is done in Australia, and you claim all the Australian activities. The supporting activity, so there would be what is supporting activity that has been conducted in Australia and also in New Zealand. But you'd be able to claim the supporting activity to the extent, or the supporting activity conducted by the Australian co-founder, who is located in Australia. The project management, oversight, etc., that New Zealand founder provides would be ineligible because it's an overseas activity, so you exclude that. Importantly, you still have that core R&D activity being conducted in Australia. And then the cost of those prototype components, if that's all shipped to Australia, built, tested in Australia, then you'd be able to claim that. Example 2, development testing of software platform conducted in Indonesia. The research, design, input, user testing, management conducted by the founder in Australia. In this instance, it would likely be that the core activity was conducted overseas. You would need to carefully look at what was done, but probably, well, in this hypothetical example, core activity, what would be a core activity being done overseas, activity in Australia only supporting. Because there's no Australian core, you can't claim the supporting, even though it was done in Australia. In this instance, you really have to kind of ignore what was done overseas, look at only those Australian activities and determine whether a systematic progression of work based on the principles of established science that proceeds from a hypothesis, blah, 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 was conducted in Australia. And the final example, we have design, development, testing of machine learning matching engine conducted by a team in Australia, design, development, testing of NLP algorithm conducted by a team in the US, and an Australian-based or a CTO in Australia providing research, management, oversight to both teams. So potentially, or ignoring the overseas, you have core activity 1, core activity 2, and supporting activity 1. Now, in this case, obviously you can claim the Australian core activity. Without a finding, you would exclude the US-based what would be a core activity. And then the CTO that provides support to both those teams, that would be a supporting activity, but you would only be able to claim the time spent supporting the Australian-based core activity. So you would need to be able to determine how much time was spent supporting the Australian team, claim that, exclude the time spent supporting the US-based team. Now, in this instance, if you could demonstrate that the US work was done because it couldn't be done in Australia, you were unable to access that expertise in Australia, and you met all those other conditions, then you might like to apply for an overseas finding, and if successful, you'd be able to claim that time as well. And then you'd be able to claim the time spent by the CTO supporting that activity. I hope that was useful. I hope everyone learned something. If you have any further questions, please feel free to reach out to the team. That could be relating to what you've seen today. It could easily be relating to other accounting aspects of accounting, company structure and setup. Crypto, we have quite a large crypto accounting team as well. So if you have any questions or would like our assistance in any area, please feel free to get in contact. If you go to our website, you can see all our services and book a meeting directly with the relevant team. Okay, then. So once again, just want to thank everyone for joining us today. All right, thanks.